Okay, so you want to own a cruise line. Picture the pitch deck. One ship, 6,000 passengers, every cabin sold months in advance. A floating city, and you own the deed. Multiply that by a fleet of 20 ships, and you're looking at a company with more annual revenue than most Fortune 500 industrials. Royal Caribbean alone pulled in over $16 billion in a recent fiscal year. $16 billion. That's not a business, that's a small country's GDP. So far, so good. Here's where the mental model breaks down. That $16 billion in revenue does not mean $16 billion of cruise line owners sipping cocktails on their own upper deck. In fact, for most of this industry's modern history, the ticket, the thing you think the business is selling, is sold at close to break even, sometimes below it. The cabin, the cruise, the thing on the brochure, that's not the profit center, that's the bait. Read that again. The core product of a cruise line is frequently sold as a loss leader, and the entire trillion-dollar mechanics of this industry exist to get you onto a ship so they can sell you everything else once you physically cannot leave. That's not a metaphor. You are, for 7 to 14 days, floating in international waters with a finite amount of cash and nowhere else to spend it. That's the business model. Welcome aboard. Now, cruise ship is not one business. It's at least 4 wearing the same uniform. Tier 1, budget and regional lines. Think Carnival's value brands or European short-haul operators. Ship cost $200 to $500 million. These are the Southwest Airlines of the sea. High occupancy, thin margins per passenger, and profit through sheer volume and fast turnaround. Less time in port, more cruises per year per ship. Tier 2, mainstream megaships. This is Royal Caribbean's Icon class, or MSC's newest builds. Price tag $1 to $2 billion per vessel. 20-plus decks, water parks, ice rinks, their own private islands, we'll get back to that. These ships are designed around one number, onboard spend per passenger per day. Everything about the architecture is engineered to maximize that number. Tier 3, premium and luxury lines, Regent, Silversea, Seabourn. Smaller ships, sometimes under 1,000 passengers, all-inclusive pricing baked into a much higher upfront fare. Here, the economics flip slightly. More of the margin is captured at the ticket stage because the guest already paid for the whole experience. Less nickel and diming, more margin built into the sticker price. And Tier 4, the outlier, expedition and polar cruising. Small ships, ice-class hulls, 6 figures per cabin for a 2-week Antarctic run. Brutal CapEx per passenger because you're building a vessel that can survive pack ice for maybe 200 passengers total. But the margins per guest are the highest in the entire industry because scarcity replaces volume as the profit driver. 4 tiers, 4 completely different math problems, same ocean. Let's talk about what it actually costs to put a ship in the water. And I mean actually. A single Oasis or Icon-class megaship runs you somewhere north of $1.5 billion. That's before a single passenger boards, before fuel, before staff. Just steel, engineering, and about 3 years at a shipyard in Finland or France, because there are only a handful of yards on the planet capable of building at this scale. Now here's the first hidden cost nobody puts in the naive pitch deck: financing. You are not paying $1.5 billion in cash, you're financing it, usually through export credit agreements tied to the shipbuilding country, plus corporate bonds. That debt sits on the balance sheet for 15, 20, 25 years. Interest payments alone on a modern fleet can run into the hundreds of millions annually, industry-wide. That's before the ship earns a single dollar. Second hidden cost, fuel. Bunker fuel, or increasingly liquefied natural gas for the newer builds. A single megaship can burn well over 150 tons of fuel a day at cruising speed. Multiply that across a 20-ship fleet, multiply that by volatile global fuel prices, and you have an operating expense line that can swing by hundreds of millions of dollars year over year, and it has almost nothing to do with how well you're running the business. Third, regulatory and environmental compliance, new IMO emissions standards, scrubber installations, ballast water treatment systems, retrofits that can cost $10 to $20 million per ship, mandated by international maritime law, not optional, not negotiable. Fourth, dry dock. Every ship, roughly every 5 years, goes into dry dock for weeks of intensive maintenance, hull inspection, repainting, mechanical overhauls. That's not just a maintenance line item. That's a ship generating zero revenue while still accruing debt service, insurance, and crew costs. And fifth, the one that quietly bankrupts operators, insurance and crew. Marine hull insurance, protection and indemnity coverage for a floating city with 6,000 guests and 2,000 crew, medical liability, all of it stacked on top of crew wages for a workforce that lives on board for months at a time. Now here's where the mental model breaks down a second time. Most people assume the ship is the asset and the ticket revenue pays for it. In reality, the ship is a fixed, depreciating, debt-financed cost center that exists purely to create a captive audience. The ship isn't the business. The ship is the store. So if the ticket barely breaks even, where's the money? Onboard spend. This is the entire game. Industry-wide, cruise lines can generate somewhere between 30 and 40% of total revenue from onboard spending. Drinks packages, specialty dining, casino, spa, shore excursions, Wi-Fi packages, photography, and critically, the margin on that onboard spend is dramatically higher than the margin on the ticket itself. A drink package might be sold for $70 to $100 a day per person, and the actual cost of goods on that alcohol is a fraction of that price. Here's the one-to-one math. Say the average passenger books a 7-night cruise. The base fare might net the cruise line a slim margin, call it single digits. But once on board, that same passenger, on average, spends several $100s more across the week. Multiply that by 6,000 passengers on a megaship. That's not a rounding error. That's often the entire profit of the voyage, sitting in the bar tabs, specialty restaurant upsells, and casino floor. This is why the ships are designed the way they are. The Broadway-style theaters, the escape rooms, the surf simulators, none of that is charity. It's a funnel. Every design decision on a modern megaship exists to keep you walking past something you'll pay for. And then there's the real masterstroke, the private island, Royal Caribbean's Perfect Day at Coco Cay, or Disney's Castaway Cay. The cruise line buys or leases a Caribbean island, builds a beach club, a water park, cabanas that rent for hundreds of dollars a day, and now even your free beach day has a revenue funnel built into the sand. It's the same logic as the airport turning parking into its most profitable square footage. The destination isn't the product. The captive spending opportunity is the product. Now, here's the second layer most people miss. Yield management. Cruise lines run some of the most aggressive dynamic pricing algorithms in travel, adjusting fares in real time based on how a sailing is booking. An empty cabin 2 weeks before departure earns zero. A cabin sold, even at a steep discount, earns onboard spend potential. So operators will discount tickets hard to fill the ship, because an occupied cabin at a loss on the ticket is still a profitable guest once you account for onboard spend. The ticket price you see online isn't the business, it's bait, repriced by an algorithm every single day. So why does an industry with this much built-in margin still produce bankruptcies? 2 words: fixed costs and leverage. Remember that debt from Block 3. That debt doesn't care whether the ship is sailing. During the pandemic shutdown, cruise lines faced a scenario that should terrify any investor in this space. 100,000-ton assets generating zero revenue for over a year, while still accruing interest, still requiring skeleton crews, still requiring insurance and mooring fees in port. Carnival Corporation alone burned through roughly $1 billion a month in cash at points during that shutdown, and had to raise tens of billions of dollars in emergency debt and equity just to stay solvent. That's not a bad quarter. That's an existential event. And it happened because the entire business model assumes near constant, near full occupancy to service that CapEx debt load. Now let's go back further. Look at Renaissance Cruises, a premium line that went bankrupt in the early 2000s. Their failure wasn't really about ticket pricing. It was about product-market fit colliding with fixed costs. They expanded their fleet aggressively right as demand cratered after September 11th, and unlike the mass-market giants, they didn't have the onboard spend volume or brand scale to absorb the shock. Smaller ships, smaller passenger counts, same debt structure logic, but none of the economies of scale that let Royal Caribbean or Carnival ride out disruption. And here's the mechanism that connects every cruise line bankruptcy in history. This industry runs on operating leverage, high fixed costs financed by debt that only get paid off through relentless, near-total occupancy. Drop occupancy by even 10 or 15 percentage points, and a profitable fleet can flip to a cash-burning one almost overnight. There is very little room between thriving and hemorrhaging in this business. That gap is thinner than almost any other travel category. So let's put a real number on this. Optimistic scenario, a well-run mega ship sailing near full occupancy, aggressive onboard spend capture, efficient fuel management, can generate operating margins in the high teens to low 20s percentage-wise at the fleet level in a strong travel year. That's genuinely excellent for a capital-intensive, asset-heavy business. Realistic scenario, mid-single-digit to low double-digit operating margins, dragged down by fuel volatility, dry dock cycles, debt service, and the constant threat of demand shocks, geopolitical events, health crises, fuel spikes that can erase a year of profit in a single quarter. And the worst-case scenario isn't hypothetical. It's on the books. It's a fleet of billion-dollar assets sitting motionless, still owed to the bank, generating nothing. So here's the aphorism to take with you. In the cruise business, the ticket is the invitation, the debt is the obligation, and the profit, the actual profit, only shows up once the ship is already 300 miles from shore and you've got nowhere left to spend your money except exactly where they built the funnel. The math gives you a guaranteed passenger count. Everything below that number is a fight for their wallet, one drink package at a time.